Hey look, welcome back. Today I want to get into Carlisle Companies. Now this company has been at the heart of a lot of argument and debate between analysts and investors over whether or not this is a good company and whether or not now is the right time to buy. Now personally, I like Carlisle Company as a company. It works on some absolutely mission critical applications which are really desired and really needed by their customers, and it makes it difficult for customers to change to another company because of the powerful sort of lock-in effect of the Carlisle systems and construction. It means that it's difficult to assess whether or not a competitor is going to have quality products that are going to match those, and this is one of Carlisle's massive advantages. Now I'm going to go over some of the financials and some of the elements here that I do like about Carlisle, but please stick around to the end because I'm also going to address some of what are the key concerns for myself that I don't see too many other people talking about, and some of the reasons why I don't rate this as an extremely strong buy at the moment. So stick with me as we get into it. There's absolutely no doubt about it, the construction industry can be a really tough place for companies. Weather issues, construction downturns, general economic disasters across the economy, all of these are going to hurt and damage the opportunities for a company like Carlisle. And yet I consider it to be certainly one of the market leaders in the segment. And what does this mean when we begin to look at their results? Let's have a quick look now. Okay, so when we begin to look at what's going on, looking at the quarter four results, this is absolutely wonderful, particularly when we begin to look at this in terms of revenue. Look, they've broken records both for the quarterly as well as the full year revenues for 2022. They have a very powerful 17.58 EPS earnings per share, which is beyond expectations and has also sort of exceeded where they thought they were going to be several years down the track. So basically, when you look at this, there's evidence that what they wanted to do and what they wanted to achieve, they are absolutely smashing it. Now, when we begin to look whether or not they are market leaders, one of the things I want to have a quick look at here is this element. Now look, their return on invested capital has been fairly consistent and strong, and it's absolutely spiked up in 2022, showing some of the power of the current results. Return on equity has been relatively strong. We see that it's more or less here near the sub-industry norm, which is important to see, and the return on assets again has generally exceeded the sub-industry norms here, although it's been a little bit weaker in recent years. Asset turnovers also, even though they've weakened a little bit here compared to the sub-industry norms, they're at least comparable. Margins have been a little bit lower than the sub-industry norms, but margins are still relatively healthy. Share buybacks. Now they've been decreasing the number of outstanding shares in 2015, for example, about 65 million shares, and that's been reduced to about 52 million in recent years. Do they have enough money to keep on paying their shares? Well, here, for example, free cash flow to shares, we have quite a powerful difference here. Free cash flow in green and the dividends paid out per share in purple. And so we can see also the general sales revenue trend here as well has been slow and steady increases as they have powered through over the last decade. Right. Now, while it doesn't look like an absolutely strong buy at first glance, I generally think that their performance within the sector definitely warrants a second look. So one of the areas where I do think they're lagging a little bit behind some of their peers is a very modest dividend payout. Even though it's pushing 1.5% now, that's purely down to the fact that the actual share prices have decreased so substantially in the recent year or so. It also implies that around 15% of their earnings are being paid out. Now that is a very, very safe payout ratio and one I'm feeling very comfortable with. Now as we saw as well, they have also been decreasing the share count through some powerful share buybacks. And so therefore they've really shifted not just from dividends but also through the share buybacks to return value to their shareholders. While the fourth quarter performance has been turning heads, it's unlikely to outshine here in the recent year comparisons. And so thinking ahead to 2023, I think it's going to be very, very difficult for them to match this 2022 performance. And so overall, though, they're really hitting their targets for the 2025 strategy. You know, for example, they've managed to hit their EPS target years ahead of schedule, and this really demonstrates their ability to perform as a best in class. Now, it is a good company, And it's not just the financials here, but their products and their services also really well recognised. For example, the Home Depot has recently given them the Materials Vendor of the Year award. They've also been looking at their production assets, they've been upgrading and modernising, and they've also been gaining on the positive pricing trends across all of their segments, even despite the macroeconomic headwinds, which is really good to see. They have been working on the supply chain challenges gradually, and as these begin to normalise, we should probably see improvements in their returns in 2023. Their overall capital structure, it's not too bad. There's certainly room here for improvement. They've got about $400 million in cash on hand. They've got about $1 billion on a revolver. So they're not exactly cash strapped. They do have some near-term debt maturities, which I think warrant a little bit of a look here, but I think overall they're relatively secure at this point. However, if we're looking at this in the short term, they do have some issues here and challenges around the sort of the general economic environment, such as the bank stresses, the interest rate stresses, and the long-term perspective here also generally makes me think that this is a company that is in a prime position for growth and development of their earnings per share. Now, as I said, it is not all beautiful, fantastic news. There is a couple of elements here that I'm concerned about, and the biggest one is really the people. So, Nicholas J. Shears was the president who oversaw the strong construction materials segment. He retired last September, and he had an ongoing role here with a consultancy role that's going to conclude in the next month or so in May 2023. Now, the construction material segment is by far the major generating revenue engine for the company. Shears was a 38-year veteran of CSL, and so his departure raises some concerns for me, given that this is the prime mover and shaker segment for the company. Koch, who serves as the chairman of the board, president and chief executive officer. They've got a really good board here of directors with individuals from a diverse range of backgrounds. People are important, employees and management is important. Now, when we begin to look at the Glassdoor website, for example, I'm looking here specifically again at the construction materials. I think there's some challenges here. So when we have a quick look through, we begin to see that 3.5 stars is not exactly a powerful and strong element here, and only about 2/3 would recommend this company to a friend. Now, Nick Shears stepping down, but he did have quite a strong approval rating here from the staff. But as we begin to scroll through and we begin to look here, we've got some elements here like a 5 stars with a comment on excellent culture. But as we scroll a bit further down, overall good, 4 stars, 2 stars, and competent management, 4 stars, good people, 1 star, review from experience, 1 star, bad attitudes, 4 stars, good pay, lots of opportunities for growth, 2 stars, not for everyone, and the old guard needs changing. So as we begin to see, this is one of the major areas for concern for the company. The people, the departure of the CEO here, Nick Shears. Overall, as I look down here on Glassdoor, I'm not entirely confident that these ratings, it looks like they're at the risk of losing some really good people and losing some of their expertise in this segment. And that, I think, is a very major risk. So let's have a quick look at what the analysts are looking at. So I'm here on the TipRanks website. We've got a current price of just over $200 a share. Now, when we begin to look at all analysts, their 12 months forecast is for about a $324. So we're talking about a range of about a 50% increase here. So this is 8 analysts here giving it buy rating. However, one of the things I do like about TipRanks is their ability to filter out just any old analyst from the top analysts. So I see here, as I go to the top analysts, the overall ratings improve, and the low rating, for example, substantially improves. We're left with half of the analysts, and that gives us an even higher buy rating here as well, which is really good to see. Now, another thing I want to see is generally what do the bloggers say about this company. So overall, most bloggers are quite bullish, so quite strongly bullish in fact. The sector average is just generally a bit of a buy, whereas most bloggers are hitting a strong buy here based on the 17 blogger opinions. Now, it's important to note there that the bloggers are more bullish on this company than they are on other companies in the industrial goods sector, and that's testament to the strength of this company and the power that they have in terms of pricing and their product portfolio. Okay, now when I begin to think about valuation, as usual I like to turn back to fast graphs. So we can see here historically Carlisle has traded more at the 15 times price to earnings level. In recent years they've been a bit higher, and absolutely here in the last year or so they have seen a price decline that takes them to a blended price to earnings ratio of about 10.25. Now this could be in fact quite a useful and valuable point to look at the company for these reasons. Now, one of the big questions that I'd have is whether or not the analysts in general do a good job of forecasting. So when we look at 1 year forward estimates, 2/3 of the time or 3/4 of the time, either the analyst is getting it right or the company are beating analyst expectations. When we begin to look 2 years forward, the company underperforms analyst expectations in terms of the operating earnings only about 17% of the time. So I think overall in the industrial goods and construction, that's quite a good result and worth looking at. So one of the big elements here that we can look at is the performance. So the dividend growth over recent years has been spotty. So they're not one of the companies that has a consistent dividend growth rate. But we can see here 2019, 16%, 14% 2020, 4% 2021, and 20% in 2022. So generally double-digit growth over the last decade, which is good to see. Now, as we come into the forecasting calculators, I want to draw your attention to a couple of elements here. Number one, the analyst estimates over the last 6 months of 2023 have been revised downwards. In 2024, they've been revised downwards, but not in each case, not by a substantial amount. But I do think that's added to the weakness here in the prices. Now, noting out here in 2025, there's only 2 analysts here providing estimates out that far, but they have been revising those estimates for the earnings upwards, which is important to see. Now, over the last 5 years, Carlisle has had a price to earnings of about 21 times. Now, if we assume that the price to earnings is retained and the prices recover to that level and the analyst estimates for these earnings are going to be accurate, we're talking potentially about a rate of return here of maybe even 150% or a total annualized rate of return of about 40% per year. Even, however, if the company only reaches about a 15 times price to earnings level by the end of 2025 and these earnings estimates are about right, then we're still talking about a total rate of return of about 77% or well into the double digits of about 23% per year. Now, this is a company that isn't perfectly strong. It does have a BBB credit rating. Now, I don't think Carlisle is an absolute slam dunk, but I do think there's a case here for some good investment with some relatively strong long-term growth prospects. Look for the total return here. There are some dividends, but they're not as powerful as they will be in other companies. What do you think? Hit me up in the comments down below. I know a couple of you have been looking at this company in the past. I personally think this is a really nice time to buy with the current price weakness, buying into a strong company with some really powerful future growth prospects. Is it on your watch list? Is it in your portfolio? Hit me up in the comments, let me know down below, and don't forget to subscribe to the channel for more useful insight. I'll see you soon.